It's the Radius Podcast, recorded live from New York City. Welcome.
Radius Podcast. Here today is January 8th, 2020. Here with Chris Sonne from NKF. I don't know what to call Newmark. I have people tell me that NKF is correct and GKF. I don't know. I don't ever remember. But Chris, thank you for being here today in the Radius studio.
My pleasure.
One of the stats that Adam, one of our co-founders, was telling me today is that normally podcasts die at or before 7 episodes. So this is episode number 8.
Oh, so
the Radius Podcast is now going to be alive forever because of you.
Oh, fantastic.
Yeah.
I thought you were telling me I'm the biggest loser. This is the one nobody will watch.
No. This is what they call an inflection point. This is where our content lives forever. So thank you. I got into self-storage 3 years ago with my team here. And when we were trying to learn about the sector back before we created any sort of data sets or platforms, the resource I came across was your mug on the CBR. I think it was on the CBRE website at that point. I don't remember if chronologically I'm playing that correctly, but the SSDS Cushman. So the Cushman stuff, the SSDS report, which is kind of what I want to talk about because you've been involved with data back before I was in college.
That's correct.
Yeah.
Thank you for the dating.
Yeah. Well, I'm not that old, so it doesn't really say that much. But I wanted to get your perspective. I want to talk to you about like how you guys were what you were doing at SSDS at Cushman on the valuation side, leading the effort to try and help inform the industry, which obviously, due to us, other players as well, the industry looks a little different from a data standpoint now today, and hopefully it's helping to benefit everybody to make more informed decisions and just know what's going on. But yeah, so help me understand how you got into self-storage. A little bit of the story. I personally like to hear that, and then we can get into how you were leading the battle on trying to create data sets back before any of this existed.
I'll try and give you the short and sweet version, but I was trained as a commercial real estate appraiser. And in the mid-90s, I was asked to look at a portfolio of about 12 self-storage properties. And to your point, Cory, there was just a limited amount of data that was available, unlike other core asset classes that had, rental data, occupancy. There was, supply and demand information that was just very, very limited. And I loved the returns of the sector. I saw that they were a cash flow based business. They had
What were the cap rates when you got into the business?
It was always a 10.
Yeah.
Yeah, sometimes a 9.
Yeah.
Back in the day.
If it was a workout situation?
Yeah. I remember we started easing down towards the low 8s. That was a big deal. Yeah, the spreads to other sectors was huge, and the supply and demand metrics were good. And as we tried to understand it, really the almanac was the source, really the longest term source, and SSDS, which was not really publicly available.
Right.
So I created a firm called Self Storage Economics a little before 2000, and we specialized in self-storage, but primarily in the Western United States. Started aggregating data, getting better things like operating expense data and things like that. And then I was acquired by Cushman in 2006 and tasked with going nationwide. And we did that. We had significant growth over the next 9.5 years, 18% revenue growth a year. And about 8 years ago, we were starting to work more on portfolios and institutional underwriting. So we looked into obtaining the database SSDS with Ray Wilson, who was kind of the founder of self-storage appraisal from going back to the 1970s when Public Storage was its big client. So Ray came over to work with Cushman and the database, and we worked from there. It was, this was prior to many of the data sources that are available today coming into the market.
Are you still looking to acquire or sell any data companies? Because we could help you out there.
Well, you might have to talk to Aaron about that. But I mean, right now we just use the data for our own internal analytics and purposes. But SSDS is still with Cushman.
Yeah. No, I mean, when we were getting into the game, we were trying to figure out what was going on. This was 2006, end of 15, trying to figure out what was going on in the sector, because there was just a cloak of mystery around what was happening with development activity, what was really going on with rates, what was going on with occupancy. And the Google search would always turn back to the SSDS reports that were coming out, which then they stopped. I couldn't find them past the end of 2015, I think it was 2015 or 2014. But that was what kind of spurred us to think, this is it. This is all the data that's available in the industry. And it seems to have ended for some reason. Maybe there's an opportunity here. But yeah, I just thought that was funny because you were the first face I ever saw in the self-storage industry when I was doing my Google searches right there.
Didn't discourage you.
It didn't discourage me. It encouraged me. This is an industry I need to be a part of.
Well, it's interesting that, as I consider self-storage today a core sector, equivalent to apartments, industrial. We've got all the institutional investors. Capital flow for debt and equity is very, very strong right now, with a lot of new players, including Blackstone most recently, putting in, I think, hundreds of millions of dollars.
Yeah.
So on the equity side. So, and the data has now, I think, come up to an institutional standard comparable to other sectors, in part because of what you folks have been doing here at Union Real Time. And I think that transparency of data, the veracity of that data, really has encouraged capital flow to the sector.
Yeah, it's funny that from my standpoint, and I haven't been in any other real estate asset classes, but self-storage just doesn't get any better in my mind in terms of it may be a single asset class in and of itself, but in terms of the underlying demand drivers, like office, you need businesses to employ to rent your space. If the economy goes down, there's less businesses. So it's a very cyclical sector.
Yes.
Apartments, obviously, as the economy turns down, people can pay less and things may impact apartment occupancy. But in terms of self-storage, the thing I always come back to and why I love the sector is you have these structural elements and counter-cyclical elements in the demand side of how self-storage works. In a down cycle, the economy slows down, divorces tend to pick up. And that's a driver of one of the structural drivers of self-storage demand. You still have some cyclical elements in terms of businesses using self-storage, and job growth tends to be the biggest, marginal, source of demand for self-storage. So it's not immune from cyclical patterns, but it's so diversified that the beta, I guess you could say, to a downturn in the economy just looks very different than if you're investing in office space or something else. So,
well, it's interesting if you look at the old adage for the sector is that self-storage is recession resistant, right? And the returns point that out. If you look at NAREIT data and do a time series event of say 5, 10, 15, 20, 25 years. Self-storage in those increments has the highest overall yield, including that's cash on cash dividend return and appreciation. And it also has the lowest standard deviation. So it's the least elastic.
Risky.
Yeah. And so it's proved itself out. And it's interesting at this is sort of the self-storage REIT week, if you will, where we do a lot of things here in New York. And in meeting with people, doing some presentations, and also going to the state seminar, the New York State, and also the KeyBank investor symposium. It's interesting because everyone says there's still more capital coming to the sector. people say, how do we diversify our portfolio and get into self-storage?
Right. Here's a question I've been thinking about. Would you, and this is, I'm leading you with this question, I guess. Would you say that most people that are active in the sector are transitioning from a development mindset to more deploying capital towards acquisitions?
Yes. And I think there's concerns of oversupply,
Right.
which of course, again, the data becomes critical to make the right decisions about supply and demand in the trade area. Not so much, and this is a unique factor of self-storage too, because your trade areas are relatively small. They're more measurable. You're not really competing in an MSA with somebody who's maybe 10 or 15 miles away. So as a result, the supply and demand metrics can be measured where your primary customer base is going to be. So that the veracity of that data becomes even more important for self-storage, because the big killer for self-storage is oversupply, because the only cure is time and population growth.
So if all the capital is transitioning from development, when I say all, I'd say a lot of the capital is going from, I'm going to try and develop a self-storage facility to, I mean, they're going to prepare for the downturn from a recently, built facility. I'm going to hope that it goes into distress, or I'm just going to start buying mom and pops. Like that seems to be the structural trend in the industry right now. But if you think about that, wouldn't that mean that if you could find an area that has the rates, demographics, and other aspects of what you need to build a facility, that now is the best time to be in development?
Well, it's a good point, because, sure, there's a certain herd mentality, right?
Right.
The way an industry will go for self-storage in all sectors. But I can go into an oversupplied MSA, and I guarantee you we could probably find a trade area that's underserved, where there's upward pressure on rates. And that's another great thing about self-storage, because, and it's the hard thing, because it's very granular, right? You really have to drill down into that trade area. You can't just say, well, LA's doing better than Kansas City, therefore I'll build in LA or something. It really has to get granular data. Which, makes it more important in understanding the supply and demand metrics, the demographics behind it. You mentioned job growth. I think also, population, percentage of renters, average household size, and average household income. And we use those metrics to econometric model to forecast stabilized demand for a trade area by measuring it to other trade areas with similar demographics.
Right. We were talking about that. I think there's more to come there in terms of what we can do and what we can try and think about helping people. To the same degree, people think about 7 square feet per capita as one of those metrics, even though it's actually more like 5.5, probably 6 now.
Yeah.
After we've actually mapped the entire country and took a look at what the square feet actually looks like. But there's more to come there. I think we're going to do some work on maybe introducing a metric or two to help people think about how much can I push rate at this facility relative to the incomes around the facility. What rates can be supported by the underlying incomes in your trade area, which is what we were talking about. Perhaps it sounds like you guys have already kind of cracked that code, but maybe making that more widely known.
You want to talk about that?
Go for it.
Sure. So we've been doing some analytics on, comparing how much are people willing to pay. There's complex algorithms with revenue management systems that large operators and the REITs are very, very good at. But since 80% of the industry is mom and pop owned, we're looking for other metrics that would help us to understand, like you mentioned, the supply per square foot is an interesting metric that can be used as a benchmark. So is there a benchmark? One of the things we found, we do about 1,000 valuations a year of self-storage assets throughout the country. So we aggregate data, and we've been comparing what we call the cost of occupancy. So what it is it's the annual average cost to rent a unit. So you take the potential gross income divided by the number of units, and the potential gross income means what they're actually getting on the occupied units, and what you would forecast market rent on the vacant units.
Right.
This is for stabilized assets.
Right. So in-place rents the revenue those in place people are generating, and potentially what the vacant units could be generating on the rents that are prevailing in the market around it.
Precisely. And you divide it and you annualize that, the monthly rate annualized, and divide it by the total number of units to get this number. Call it $2,500 a year. And then you compare it to the average household income. Call it $100,000 a year. That'd be 2.5%. So, think of things you spend 2.5% of your average household income on. Starbucks. I know a lot of folks that have bar tabs higher than that, right? Yeah. I mean, there are things we don't think about a lot. And that creates tenant stickiness, the ability to raise revenue. And I think that's an interesting metric, because what we found is that about 2.5% in most markets, New York, you can get into the threes. But in most other markets throughout MSAs I'm speaking of, about 2.5% is kind of the ceiling. So if there's an MSA that has, say, below 1.5%, it would suggest that there's a lot more room in that MSA for revenue enhancement to increase rents.
Right. Right. So just creating a metric to understand based on how much people are making in an area, generally speaking, they're willing to spend 2.5% of that per unit.
For grandma's plates and all my other emotional memories.
Right. Yeah. I use self-storage from the time I left high school in college. I mean, I use it every summer when I'd leave college.
God bless you and thank you.
So, and we used it a little bit when I lived in Colorado. I still remember the old public storage, orange doors. We had drive-up units. I'm not sure why we used it at that point. It's probably for grandma's stuff, or one of the relatives. But yeah, and then it becomes just this safe haven where it bleeds you every month, and you don't realize it. But I was storing my skis in there, doing other things. What else am I going to do? Am I going to throw it away? Probably would have been the prudent decision, just buy a new pair with all the money I saved. But that's just how human brains work. I think they have difficult times letting go of those.
Yeah, well, and your folks are saying, "Hey, you're in college. You're an adult. Don't store it at my place anymore."
Yeah, well, I was in New York versus my home was in college, so the shipping costs would have been too high. But
yeah,
yeah, no, that's a interesting metric to help people frame up where are rents relative to what people can afford.
It is interesting. We've tested it with some folks that have more complex algorithms and had some interesting correlation. Fairly good. Seems we're pretty close about 80% of the time we've tested it to larger portfolios. And so it's not the answer, but it's a nice simple metric to your point in terms of square feet per capita or this ratio or cost of occupancy analysis.
Right. On the stuff that you're analyzing, and you're doing the big institutional stuff for the most part. So you may not be seeing this yet, but have you seen any push in the new assets you've been underwriting on the automation side? Have you seen any of the new stuff out there with the, Janice has got the Noki, other things like that? Have you seen any real tangible evidence that people are implementing the stuff yet? And if you are, does it make a difference from a valuation standpoint?
Great point. It's mostly anecdotal. In other words, we come across it, but I haven't seen a huge trend. I think the thought that I get from the market is that over the next decade or two, it is the way to go as the technology improves. You've seen some of the robots that work pretty well. I know a company, I believe in Australia or something, that has a pretty impressive system that the machine actually moves around the complex. And
I think Storage King actually has a facility like that they they have
Brian's
a big arm that moves the unit down to you.
Yeah. So I think it's a really interesting growth because on-site costs of property managers is very expensive, and currently one of the concerns of expenses increasing in the sector with wage growth. But also, I think there still is. I always think of the managers in the old day. It used to be the retired couple, right? The blue-haired lady and her husband, the smoker, in the office, and you walk in and you get all this. So I think it's interesting to see that the improvement in on-site management, and just that it's more customer-based, the way people experience self-storage, because they shop online, right, for the most part, but then they come in and what's the experience? And people have that sense of safety and comfort and security that is so important to them, sort of those psychographic data points that are really hard to measure, but it still seem to matter in the sector. So it's going to be interesting over the next years to see how quickly automation can be accepted by the customer, because it certainly would change valuation. On-site management's one of the larger expense categories.
If you were evaluating 2 facilities today, holding everything constant, one had the Bluetooth unlock your door with your phone, and one had standard sliding lock doors, is there any real consideration from a valuation standpoint about how you would look at, like, basically the value at that facility, what someone should pay for it? Because it's, there are upwards of like $200 a door to put in one of these Bluetooth locks. At times 1,000 doors, you're talking about $200,000 on a facility that costs $10 million. Like, that's a big figure. I think there are tremendous benefits, but the question is do those benefits at this point necessitate you spending $200,000? So from a valuation standpoint, do you look at it any differently yet?
It's a 6.3% increase. No, I'm kidding.
Yeah.
We don't exactly know, because in part, how is the customer going to react to that? Somebody your age, no problem. You're going to love it, right? Folks my age, some may resist, right? They may not be comfortable with the technology.
Well, it may be something you've experienced after you already agree to pay whatever price you're paying.
Right. You may not be able to increase. So, or you'd have to increase.
I'm not making the argument against it. I'm trying to figure out how I can see how the convenience factor goes up exponentially from my standpoint. It'd be awesome. I hated carrying around those keys on my keychain or figuring out where they were every 6 months when I got to go do it.
Yeah.
But when I'm making the decision of Extra Space down the street versus CubeSmart versus Public Storage, as an uninformed consumer, I'm likely not going to have the frame of mind to know that this one's got automatic doors, this one's got locked doors. It's not the first thing that pops up. Is it climate? Is it on the first floor? Bam. All right, I'll go pay for it. Then I show up and it unlocks with my phone. That's a great bonus, but did it mean that I actually paid more for the unit?
I don't think we have the data to make a real determinant of that, but I think I would say that in general, it probably is going to increase your competitive position a bit, right? Because you have some features. That's what amenities do. It may not get you a lot more money initially, but it might increase your competitive position a little bit. It's like, think of a modern new facility compared to a 30-year-old self-storage facility. Even if the 30-year-old facility, even though it's still looks, it's garage doors, right, essentially, that roll up, people like the new and shiny, and self-storage design has changed and gotten much more, it doesn't look like self-storage anymore.
Yeah.
So I think that the customer experience coming in and saying, well, that's a nice feature.
Yeah, maybe they go home and they tell their friends about it, and that's the reason why that friend goes to the facility.
Yeah.
So that's the difficult part is kind of understanding how this actually impacts, because it's awesome technology. I think it's so cool. Yes. But then I've been thinking a lot more about actually where the rubber hits the road in terms of when you're building one, you're going to put an extra $200,000 into a facility, actually put those in. Where's my confidence level that I'm going to get a return on that investment?
Yep, that's the key.
So I don't have an answer. It doesn't sound like that there is one. There is one yet.
Data yet?
Yeah. What do you think the storage industry is going to be talking about in 12 months from now? I didn't prep you with this question. I'm putting you on the spot. So is it still supply? or is it something else?
Well, outside of exogenous factors like something large in the economy,
Like Iran firing missiles at us.
that would be a good example, yes. And uncertainty in the markets, which always means it's about confidence, and that can create challenges. And hopefully, many of these issues will be resolved. But after the election, I think there's going to be a little bit of caution. Most folks have this sense. What I get from the market sentiment is that a lot of people have this sense of confidence through the election, not only for the economy in general, but self-storage particularly. And then after that, there are concerns of how long will this cycle continue to grow. Now, many pundits have been wrong, over the last few years because of the length of this great cycle we've had. Just think of interest rates a year ago were 85 basis points higher. I think in our survey research we do of market participants, nobody forecast that. So I think probably people will be a little bit kind of, being worried. There'll be caution. And I think there'll be people that are more nervous about people being nervous.
Yeah.
Because there's uncertainty.
So not a question about who you want to win, but who do you think is going to win the election later this year? Because that's obviously kind of plays into what you're talking about in terms of fear of if it's a Democrat, obviously consumer protections and the SSA advocacy becomes more important.
Yes.
Or if Trump gets reelected, it's a different path. So who's gonna win the election?
Well, I don't know. I thought I'm in New York City. I have to say Bloomberg, right?
Yeah, I think so too.
Okay.
All right, we're at 29 minutes, and I think structurally self-storage podcasts are only allowed to go 30 minutes. So I think we'll probably just end it here.
That's enough on self-storage discussion for the day.
Yeah. Chris, thanks for coming. Great to see you.
Thank you very much.
Legend in the self-storage industry. The first mug I ever saw when I started looking into it.
Poor guy.
Yeah. So,
all right. Thanks, Cory.
Thanks, Chris.
You've been listening to the Radius Podcast. Don't miss a beat. Subscribe today and stay up to date on self-storage. And come and hang out with us at radiusplus.com. We'd love to hear from you.